US trade deficit records sharpest surge in over 3 decades, raising growth concern. The United States recorded its most dramatic monthly expansion in the trade deficit in nearly 34 years this November, underscoring how America's rapidly evolving economic engine, particularly the artificial intelligence investment boom, is reshaping global trade flows and complicating near-term growth projection. According to data released by the Commerce Department's Bureau of Economic Analysis and the Census Bureau, the US trade gap widened by an extraordinary 94.6% to $56.8 billion. This marked the steepest percentage increase since March 1992 and far exceeded economists' expectation, which had pegged the deficit closure to $40.5 billion. The surge was driven primarily by a sharp rise in imports, reflecting the United States' accelerating demand for advanced capital goods. Total imports climbed 5% to $348.9 billion, with goods imports jumping 6.6% to $272.5 billion. At the heart of this expansion were capital goods, which rose by $7.4 billion to a record high, largely fueled by soaring purchases of computers and semiconductors, key components powering America's AI-driven industrial transformation. The investment-led import boom highlights a defining paradox of the current US economy. While technological modernization strengthens long-term productivity, it simultaneously deepens short-term trade imbalances. Consumer goods imports also hit historic highs, rising by $9.2 billion, led by pharmaceutical products. Analysts note that wide fluctuations in pharmaceutical trade have increasingly been shaped by tariff structures and supply chains realignment. By contrast, imports of industrial supplies declined by $2.4 billion, offering only marginal relief to the overall imbalance. Services trade offered a partial counterbalance. While imports of services declined, exports in this category reached a record high, reinforcing the United States' enduring strength in high-value services such as finance, technology, and intellectual property. Nevertheless, this was insufficient to offset the sharp deterioration in goods trade. The November figures carry important implications for economic growth. Trade had been a significant contributor to US GDP expansion in the second and third quarters of 2025. However, the sudden widening of the deficit is likely to temper expectation that trade will gain bolster fourth quarter growth. While the Atlanta Federal Reserve currently estimates that the US economy expanded at a robust 5.4% annualized rate in the fourth quarter, several major Wall Street institutions, including Goldman Sachs, project a far more modest pace, well below 3%. Ultimately, the latest trade data reflect an American economy in transition, one driven by aggressive technological investment and domestic demand, yet increasingly exposed to global imbalances. Whether the AI-fueled import surge evolves into sustained productivity gains or becomes a drag on growth remains a critical question for policymakers and market allies.